Okay, so these are the various categories. I'm going to talk about some of the important factors of each category. So the first category I'm talking about is producers. What you're looking at on producers is um, growth and free cash flow. So it's tough for small producers to have significant cash flow. So I try to look for companies that are either going to be 100,000 ounce producers or already are. Um, I will go down to say 50,000 ounces to 100,000 ounces for some stocks, but those are kind of the outliers. The only reason I'm really buying those is because they're cheap. They're just really undervalued, but that's not really where I'm get excited. So a 100,000 ounce producer should be worth somewhere between 500 million and $1 billion at say $2,500 gold, depending on the location, depending on the balance sheet, depending on the cost. And you can even, let's say a company has a low cost, good location, good balance sheet, it could actually be valued over $1 billion. That's not unusual. So and those factors all come in. So this is kind of the range. And then again, 200,000, you can pretty much double it. And then again, 300, 400, you can just keep going up the ladder. It gives you a general understanding of the value of a producer. Um, and so we're looking for companies that can add ounces because I talked about this earlier. If you can find ounces for $25 and then you can get them valued at 500, the leverage is huge on upward valuation. So that's kind of what I'm looking for. I'm just looking for production ounces, growth, um, and then of course getting in at the right price, where you have your upside potential. Um, and I think we're going to talk about that as well. So for development stocks, you're looking at um, the main value drivers are trying to once they get into production, you don't want to get a small company per se, like real tiny capex, unless it's has the growth potential to get to 100,000. So we're looking for companies that have fairly decent starter mines. So a starter mine is usually somewhere with a capex between 50 million and 200 million. And then once you get over 200 million, the capex starts getting big. And large capex, it's going to require high dilution, high debt, and a long time to build. So I don't really like on these development. When I talk about development, I'm talking about first-time mines. I'm looking for a starter mine. I really, there are some development projects where you go, higher than 200 million, but those are the outliers. The sweet spot is like I said, 50 to 200. You're looking for those sweet spots where they can basically start production somewhere between, you know, say 75,000 to 150,000 ounces of gold, and then they have growth potential on top of that. So they can get to 100,000, they can get to 200, they can grow. So that's kind of like the starter point. Now IRR, it's important. You want to avoid low IRR projects. This is the internal rate of return. So anything that's sub 20%, the only time you really want to be interested in something like that is if it's an optionality play and they have a lot of resources and they're really cheap. Then I could go down to say 15% IRR at $1,300 gold. Um, I don't have a problem with that if it's a lot of resources, because all of that, it all becomes economic once you get higher. Um, I still look at IRs at $1,300 gold. I know we're going to start to get above that, 14, 1,500. I even saw one company do an IR at 1,800. I thought that was a little hilarious. I thought they were getting ahead of themselves there. But it'll start inching up here. But yeah, so ideally you want to see, like I talked about these starter projects here, you want to see these IRs say over 30%, gives you some comfort zone. That way they're going to get built. If a company has an IR under 30, it's going to be really hard for them to finance the mine. Banks just aren't going to be interested. Usually anything over 30, at $1,300 gold, they can usually raise the money, and not always. I've seen it just depends on the company. Sometimes they can have a 40% IR and have some trouble, but 30 is usually kind of a good area. You can feel comfortable that these projects will get financed. The MPV, what you're looking for here is you want the MPV to be substantially higher than the CapEx, and substantially higher than the current market cap. So let's say the MPV is 200 million and their capex is 150 million. So it's just a little above it, and then their market cap is like 80 million. So that's kind of marginal. But what you would like to see is even bigger. You'd like to see the MPV like at 300 million, and then the capex like at 150. So that's like double. Maybe even the capex at 100 million, and then the current market cap like under 100 million. You want to see some air between the MPV and their capex. If you see an MPV and then the capex and the market caps are like all around the same place, that's just not going to have a lot of upside potential. The key ones is the capex and the MPV, but the market cap I always look at that as well, because the MPV that's where the value is going, right? So if the current market cap is 100 and the MPV is 200, it's basically saying it's only going to go up 100%. So you really want I like to see the MPP well above these two numbers. So I always look at all, these are the kind of the three important. There's other factors that come in development stocks, of course, like the insiders, but these are some of the important ones to look at.